Let's go on to story number 2. Sean, we're going to stick with you with story number 2. This is coming out of the South Florida Agent Magazine. I'll read you the headline, first couple graphs, and I'll ask you to comment. Headline, Case-Shiller, which is the name of a research or ratings company, or an index, I should say. Case-Shiller, home price index just 0.02% off 2022 peak. Miami sees 2.5% gain. And first couple of graphs, Sean, and then I'll ask you to comment. Home prices rose for the fifth month in a row in June to essentially match an all-time peak reached a year ago, S&P Dow Jones indices said. Specifically, the S&P CoreLogic Case-Shiller U.S. National Home Price Index rose by 0.9% month over month and was just 0.02% below its year-ago level, which marked the historic high for the measurement. June is the 5th consecutive month in which home prices have increased across the U.S., said S&P DJI Managing Director Craig Lazaro. With 2023 half over, the national composite has risen 4.7%, which is slightly above the median full calendar year increase in more than 35 years of data. In Miami, home prices posted a 2.5% year-over-year gain in June, while home prices rose 1.4% month over month. John, now, granted, we are in September when we're recording this. This data is coming from June. It's a little bit staggered, if you will. What do you make of this? The fact that overall it looks like it's somewhat flat, but Miami had this 2.5% increase, which I will point out is less than inflation.
Yeah, I mean, this market is completely distorted by what the Federal Reserve has done in the last few years. I mean, it's at this point in the cycle, we should not be seeing this at this point of the interest rate cycle. Because I mean, with rising interest rates, this shouldn't be happening. But it just shows that the market's completely screwed up in terms of a limited inventory. There really are no homes sort of in the lower price ranges. That those homes, I mean, those listings have been completely obliterated. And so now you're seeing mostly, higher end homes, and so it's completely distorting the data. And now you have, with interest rates, so low, 2 to 3%, everybody's locked in those mortgages. Nobody's moving. It's a frozen market, and you have hardly any inventory. And when you do have transactions, it's so few transactions that it distorts the data. So, I mean, these numbers, this data, these indices are really reflecting how the whole market is just in this weird, unrealistic and distorted state. And I think it's going to be a while before it clears out because inventory's got to come back on. We have to have sales. I mean, the number of sales has declined by in the low double-digit percentages for the last 6 or 7 months in the Miami area. So I mean, with that, how do you rely on this data to make investment decisions or buying decisions? It's really very difficult, and it's misleading and it's distorted. So, I mean, obviously it's accurate, but it's distorted.
Yeah. John, quick follow up. Last week's podcast, you referenced about 55,000 rentals coming onto the market. How do you anticipate that those rentals, assuming they all get built and they're all funded, how do you think that will shake up the overall single family home market in the Miami or South Florida area?
Well, I mean, because you've wiped out a whole segment of the home buying population, basically, and these are going to be people who are going to be renting. But the 55,000 units under construction in South Florida is a tsunami of rental units, and I just don't see the absorption happening as perhaps people might have expected during the pandemic when everybody was moving down here.
Yeah.
So, I don't know. It's going to be interesting to see.
Very good.